The S&P 500 was not in a very festive move today, dropping another 65 points, breaking below 2,400, hitting the magical 20% bear market mark here at the close of the day, closing right at the lows. So what does that mean? What does that mean with what we were just talking about Friday in terms of what we expect to see and when we expect to see some kind of reversal and what it will look like? It was the worst Christmas Eve ever, but this drop that we've gotten this amount of time is not unprecedented. It's not even unprecedented for since those March '09 lows. We've actually had a similar drop now since 2009, since the Great Recession. How did the market respond then? That's what I'm going to break down today with a trade idea to take advantage of this sharp selling. So let's go ahead and get started. Today is Monday, December 24th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at what's going on with the S&P today on a half day. Doesn't matter. As you can see, we continue lower below 2,400 this time. So a couple days ago, we had dropped below 2,500. A few days before that, we had dropped below 2,600. And about a week before that, we dropped below 2,700, coming off of a high at 2,800. So since December the 3rd, so exactly 3 weeks ago, we've gone from a high, near-term high at 2,800 to breaking below 2,400 and bottoming out at 2,351, which happens to be right about at the 20% mark. And as you can see here with my calculator, if I move this over, 2351.10 divided by 2940. 0.91, and you can see that is right at the 20% mark. So as a magnet, the market hit the magical 20% bear, quote-unquote bear market pullback, and it happened in a quarter, right? Because this peak was on September 21st, so a little bit more than a quarter, but from September 21st to December 24th, similar to 2011 in Q3. When we dropped about 21% in 3 months. Here's a 20% mark. So similar drop we're getting right now to what we saw in 2011 at that time frame. Again, as I tweeted out, for those of you who follow me on Twitter, I tweeted out that the last time when we hit off that low point, when we also had fallen 20% plus in 3 months, 7 years later, up to this September, almost 7 years later, like a few days off of 7 years, we had rallied 25% a year on average for a total of 173. So this 20% pullback is giving back 20% of 173% return that we had off of the last quote-unquote bear market low point. Because that in gray, that gray box right there, that was also a 20% plus, it was about 21% pullback in 3 months. So what we're getting right now is the same percentage drop in the same amount of time as what we got in that gray box right there. There's actually this inside of it, just right in this little, that where my peak cursor is, this right there from that peak, because this was a little bit earlier in the year. So from that peak down to that low point there, that's a 3-month decline. That is a similar drop percentage-wise as what we're getting here. So it doesn't look that way because that looks a lot bigger. This isn't a logarithmic chart. You can see the numbers are equally spaced. That means it's an arithmetic chart, not a logarithmic chart. But if it were a logarithmic chart, then you'd see the exact same distance here as you see from right where my cursor is to there. And so the gains that we had since then, and that we were pretty gloomy then. Remember the credit downgrade? The U.S. had its credit downgraded by Standard & Poor's. I mean, the world was literally going to end back then. I recall that very vividly. I remember doing a special Saturday morning session that actually launched a new product at my former employer of doing Saturday morning sessions. That was our first one that we did. It was an emergency type session, a kind of a quote-unquote markets in turmoil type session that we did. That next morning, we talked again, similar to what we talk about now. When we get these steep declines, they end up being pretty decent buying opportunities once you get that long lower shadow, right? That long lower shadow is what reversed it then. And that's, as I mentioned today or Friday, in Friday's video, that's what you need to get a reversal. So you need long lower shadows. See all these long lower shadows on this on a weekly chart, which means that early in a week, like a Monday, like what we're getting right now, the market drops to a level that's just insane. And then the market reverses midweek, and we finish higher, and then we reverse on a long-term basis. So whether that ends up being the case now, that was the case back then. That was October the 3rd or 4th, I believe. Yeah, October the 4th of 2011. That was the case then. We hit that low point October the 4th. That was about a 21% drop from the all-time high at that point. And then that's the move that we had since. And then, of course, that 25% a year return includes that death cross we had in 2015 and 16. So this goes to show how bullish we were, and then again how small in comparison that pullback was once you put it in perspective of time. But what we didn't get in 11 was 6 consecutive oversold clusters. That's we haven't had that at all in 20 years. 6 consecutive, even in the most bearish of bear markets, even when the bear markets themselves were ending and we were falling off a cliff in 02 and at the end of 02 and at the end of 08, we didn't ever get 6 consecutive oversold clusters on the S&P 500. That's a little unprecedented there, and you can see same thing, 6 consecutive oversold clusters on the Dow Jones Industrial Average. Similar pattern here on the Russell. We're getting 5 on NASDAQ, excuse me, but it almost includes market sentiment, and the Russell actually does include market sentiment. The Russell has gotten 7 consecutive oversold clusters on the daily chart, all 7 of them including the market sentiment line, and that's coming off of a period where we had 7 in about 10 days over here. None of these included the market sentiment. So this goes to show how significantly oversold we are in such a short amount of time. Of course, linear regression, when you look at linear regression on the S&P, we are continue to trade outside 2 standard deviations. Same thing on the Russell 2000, continuing to trade. And that's just not on the 1-year chart. Again, the longer the time frame, the more significant the signal. So 5-year chart showing a dropping outside 2 standard deviations. A 10-year chart closing below 2 standard deviations on both the S&P 500 and the Russell 2000 closing below its 10-year 2 standard deviations of its 10-year linear regression. Again, this shows how significantly bearish that is. If I were to take a look at the 20-year linear regression trend line, obviously a lot more significant than even the 10-year is, it shows just how bullish we were before this month. And look at this month, still not even getting back down to the linear regression trend line of the 20-year chart. So there's the 20-year, remember, includes 2 bear markets, as well as this bullish rally we had off of that low point. And we were, at the time before here in September, we were outside of 2 standard deviations to the upside. So this shows how bullish we are and how much we reversed in 1 month. And again, this is a monthly candle, and if you remember, this is one of the biggest monthly candles that we've had in a while. Again, arithmetic, right, not logarithmic. But one of the few so far, because we still got a few days left in the year, one of the few months that we've had this big of a decline without a long lower shadow yet. So whether that ends up being the case this week or not, obviously remains to be seen. If you take a look at the long-term chart, you can see now we're a smidgen below the 50 percentile, 50% retracement of the move off of the 2016 low point, the last quote-unquote death cross that we had here when the 50-day cross below the 200-day moving average. We are, you can see this. If I were to go back again to that 2011 low point, on an absolute basis, you can see just how big we are now on that long-term chart. And also too, we were only at a 38% Fibonacci retracement of that move. We had a little brief 2010, but that was very brief death cross there. This is more of a extended run similar to what we had here. So this is a little bit deeper of a pullback than we had either of those times. This move here off the 2011 low basically only got us to the 23% Fibonacci retracement. So after coming off of a smaller pullback, we had a little bit of a deeper pullback here. Let's take a look at the 3 green arrow chart. Obviously, we have 3 red arrows, and we're nowhere near a green arrow in either one of those because of how far below we are the moving average and the MACD. More than likely, we'll get a green arrow on the stochastics first. When you have these kind of sell-offs, the stochastics will turn green first, and it'll get above 20, and then you'll see the MACD cross up above its moving average. But it's extremely low. You can see how far away we are below the 8-day moving average. It's rare for us to stay too far away below the moving average, especially that extreme, without some kind of a retracement back relatively quickly. The moves back to the 8-day are relatively quick. So that's how the long lower shadows are formed, are those sharp bounces when you get extremely far away. If you were to look back here, and you can see here's during 2011, there's the biggest extreme that we had away from the 8-day moving average. We're about 105 points away. I changed the MACD to show how far away from the price is from the green line, over 100 points away. Well, if you look at the weekly candle, so I have to go back 10 years on that 2011 time frame. So let's go all the way back to 2011. So there's that week right there. So you can see the long lower shadow occurred because we hit extreme levels away from the 8-day moving average, similar here, and then we popped right back up. Right, this is again a weekly chart. That's an 8-week moving average, but you get the idea. So again, that's what we'd expect. Considering now here we are, over 100 points away. We are down to 140 points away. Keep in mind, we're at a higher level now than we were in 2011, so we're not, as a percentage-wise, as far. But we are pretty far away, farther than we are anytime this year. And you can see over here, this is where the long lower shadow occurred on the weekly chart when we got that far away from the 8-day moving average. So when you get this far away, we tend to bounce back up pretty sharply. It doesn't take too long. I mean, look, you can see we don't stay down at these extreme levels very far before it bounces right back up. Of course, you look at the 4-week moving average, and we hit a new low today, so 232.61 below 240, which was Friday's low, which means that that the 280.40 high hasn't changed. So we still have, when you look at the price channel here, let's just go here, and we'll go to, let's remove all these. Let's pull up the price channel indicator. Price channel. There we go. So the price channel, you can see how wide it is up here at the top. Well, it's at 16% now of the high of that 2818 on SPX. So again, the highest mark it's hit all year, and you can see when it hits these extremes, those are your low points. If I were to go again all the way back to 2011, that we were a little bit higher than that. If I were here, we'll draw a line here at 16%. Is it 16.0375? So there's our line, and if I were to go all the way back here to 2011, we had gotten to 18% then, right? So it kind of shows again how, and that's where it set the low point. Then October the 4th, we had kind of diverged here, and you can see the new peak was off of a high point. We had pushed up to a really high range, and that set the high mark. So needless to say, 16%, as you can see, is a very, very high value. And again, how far away from the 8-day moving average, how extended we are below 2 standard deviations of that 1, 5, and 10 year. And considering that this is a Monday and long lower shadows on weekly charts have big drops early in the week to form them, then there's a good chance that this week could be that week. Even though it's only a 3.5-day week, this week could be that week that we get the bounce. So it might be a little bit more of a volatile holiday week of trading than normal. Of course, when you look at the days range today, again, above average. The average right now is 6 points. We're 6.5 point range. Volume at 147 million, but only a half day of trading. So it puts that into context. Double that number to get an idea of how much volume we would have in the regular day. You put those numbers in the context here. 6 points of trading on a half a day. You know, it was a little bit above average. Volume was 147 above average on a half day again. You can see the ATR to price ratio is at 2.5%, suggesting again any bounce we get most likely will not resume the upward trend. Obviously we're going to muddle around as we bounce up in this area 260 to 280, where there's going to be a lot of overhead resistance now since we broke through it. Finally, we'll take a look at the volatility, and today the volatility really ramped up a lot. So we did not get above 115% Friday, but today we got up to 125%, and you know, again, that's a high number. You look at, you know, we hit 125% earlier this year in February when we hit that mark, and of course in 2011 we hit close. We didn't quite get up there in 2011 to 125, but on a closing basis, on a weekly chart, if I were to go to a daily chart on this, there we go, the daily chart, and then zoom in on that chart and go all the way back to 2011, this is 14. You can see, if you know, periods of time where we hit 105% in 14, 115%, there's another few periods of 105, and then there is 2011 where we hit 125%, and from that peak you can see the trend down in volatility before we finally broke through in December and continued to rally in the bullish territory. So you can see how the volatility moderated from that extreme level. But remember, the market itself didn't hit the low point until this day right here, October the 4th. Where we had opened up the day above 45, and on that day, the last time we closed the day above 125%, at least, you know, in that August of 2011, the VIX was we closed the day at 48. Today we're only closing at 36. Earlier this year we closed at 125% there on 2/6, and you can see we had closed at 30 after peaking at 50. So we had hit a high of 50 at this time frame. The highest point that we've hit in volatility is where we closed today. So again, another suggestion that you know, that this bounce, this long lower shadow on the weekly chart could very well occur this week after the Christmas holiday comes through, as volatility finish. You know, it's rare for volatility to finish at the end of the day at the high, and when it does, usually reverses back down to the downside relatively quickly. All right, now let's take a look at what's driving the price action here, and you can see obviously the what's going on here with liquidity concerns continues to drive risk appetite. You know, this is over 2 weeks. Crude oil especially. Look at crude oil. This is from that October 3rd high point. Crude oil is down 42% from that October peak. At least the ETF that tracks it. There's the S&P 500 down almost 20%. Remember, it's down 20% from the September 20th peak. This is from October the 3rd. There's value stocks, pretty much similar declines as growth stocks. There's small caps and mid caps, so very broad-based selling. Dividend stocks also pretty strong losses. Preferred stocks holding up well, and of course high yield holding up pretty decently too. Relative to stocks, and even if it's underperforming investment grade. And of course gold and long-term bonds, your safe haven areas, all up, and even the dollar's got a small gain, but those are your two biggest safe haven areas, long-term bonds and gold, up 5 to 6% during from that peak. So very, very broad sell-off that's not just limited to the U.S. And again, very similar to 2015, where the weakness globally finally caught up to the U.S. markets. Well, we're seeing it here, and you're seeing clusters all over the board here in a lot of these areas. Brazil now, Korea now, you can see Japan, China got a cluster today. Russia's getting clusters day after day. So, you know, this is a broad-based selling in Europe and Asia and emerging markets and developed markets and U.S. stocks. Even if emerging markets have half the losses as what you're seeing in the S&P 500, and even developed markets are performing better. Remember, they had much steeper losses heading into that October 3rd level than on a year-to-date basis than the S&P 500 did. Of course, not much on the calendar today, and we won't get anything really until the Thursday, the 27th. And then on the 28th as well, you get Chicago PMI. So you start a new basket of data coming out here. So we'll get some economic indicators later in the week. Economic indicators as a whole have been coming in below their estimates, but not as much as what we saw earlier this year. Same thing globally. We were at a lower level there. GDP estimates is still at 2.7%. So we're not seeing significant declines in earnings growth and expectations, or even economic growth expectations. It again shows how much this decline has been really sentiment driven, headline driven more so than fundamentals. Of course, stock market will always price in expectations and won't necessarily be a real-time reflection of fundamentals. But even those expectations on a macro level are not looking as bearish as what price is showing. And one thing that kind of stood out to me today was, so here's the March meeting. We're looking at a rate cut. We're looking at very, very small odds, but some odds nonetheless that there could be a rate cut as early as March. Of course, the higher probability is that we'll just get nothing in March, neither a rate hike or a cut. But you can see here the rate hike odds, which were pretty high. We were in October, we were close to 60% odds, which was very normal to be able to get a rate hike in March. And the gray line now, remember, is down to 12%, so it's dropped even further. Very, very low odds that we'll get a rate hike. In fact, the purple line, which was not getting a rate hike at all in December, we ended up getting the rate hike and all, so that should have dropped down to 0, but it's starting to bounce back up because now there's increasing odds we'll get a rate cut. In fact, if you go again to the end of the year, where the Fed chair just barely told us to expect 2 rate hikes in 2019, the market is saying here that we got about a 4% chance. 96% chance that we'll get either 1 rate hike or none. And now we're getting a 14% plus chance that we'll actually get a rate cut sometime this year and come back down by the end of the year instead of up. Small chance that we'll get about a 22% chance, or about 25% chance plus that we'll get 1 rate hike in 2019. So 1 in 4 chance, not very high odds, and of course, 4 in 100 chance that we'll get a 1 in 25 chance that we'll get 2 rate hikes, which we were just barely told to expect from the Fed chair. Now let's take a look at the sectors and how they've been performing since that same time frame. Utilities had a steep sell-off today. In fact, one of the biggest losers, energy was the biggest loser, of course, with the continued drop in crude oil. Utilities and real estate, very interest rate sensitive areas. In fact, discretionary and communication services and technology all outperform the markets. Small outperformances, but they all outperform. Healthcare continuing to outperform. So you can kind of see what's going on here. Here's the new sector selector rankings based on Friday's results from Brandon's proprietary tool that he updates on our blog. You can see the clusters forming all across the board, all except for utilities, because utilities it's still at 22 on the intermediate line. All the other intermediate values look all single digits. They're all in the single digits, similar to the S&P at 4. That's the only one that's still above 20. But considering the steep sell-off we had today, we'll most likely get below 20 Wednesday, if not Thursday or Friday. So oversold clusters across the board in a lot of these areas shows how, again, broad-based the selling has been. When the markets are very bearish, correlations are close to 100%. Everything sells off. As you can see, real estate now and utilities and staples, even though they're not selling off as much, and their values here from the highs are much smaller losses here in the single digits versus, like I said, 20% on the S&P. So they're holding up much better, but they're still showing losses and they're still dropping just like everything else. So correlations are close to 100% when things fall. Correlations move closer to 0% when things rise, because then you have rotations that different sectors take their leadership turns. But when things go bad, everything goes bad, just to different degrees, as you can see over here in this column. Right now, a lot of stocks are going to look like the S&P 500 because, again, correlation is going to be very high. You can see Disney being one of them after breaking through 110, which would be its equivalent 2600 level. It's dropped down to some pretty significant support really over the last few years here, right around 100, a little bit below it, plus or minus a few bucks. So we're dropping down to an important area that we've hit a couple of times and bounced. Last time going all the way up to 120 when we hit down to this level. You can see again going to the daily chart, similar to the S&P. We've got multiple clusters in a row. As you saw, we didn't get a cluster on the weekly chart, but we are getting multiple clusters on the daily chart. It is also trading below its 2 standard deviation channel, just like the S&P. Not as much volume today, remember, but a lot of volume on Friday when we had a full day's worth of volume, 2.5% plus on its ATR right now relative to its current price levels. You can also see other indicators that reflect the extremity where we're at here, and there's a lot of this volume support area for Disney. You can see the let's see, let me go to a daily chart on this. This would be the Bollinger Band width. Again, the last time we had this high was coming off of that decline on earnings in 2017. We pushed down a little bit lower here before finding the low point, a little bit below $100. But again, you can see it's very, very high levels. We were also this high on the bandwidth back in 2016 when we bottomed out right around $90. So we're at an important level. A lot of volume in the last few years in this 100 area. You look at other indicators like the DMI. Again, reflecting the extremity, we're close to 40 on that minus line, highest level we've been this year. The positive DMI is as lowest level that's been this year. And then you look at other indicators like the 3 green arrow. When you break those 3 green arrow indicators into their 2-line versions, again, the MACD is very, very extremely low level. Same thing with the stochastics. Way far away from the 8-day moving average. Here, let's change that MACD to the current price compared to the 8-day moving average here. Again, you can see just how extremely far away we are from that. Again, if you notice, every bottom here on the 8-day moving average isn't we don't bottom out. They're very sharp points here, which means we jump back up to the 8-day pretty sharply. Here, let's go back 3 years so you can see it on the daily chart, some of these other time frames. When we get this far, and this is pretty far, see all these low points. They all jump pretty sharply to that 8-day moving average as we bounce back up pretty quickly when we get this far extended away. So again, looking for something similar to happen here. You don't want to be too aggressively bullish, but you can sell the 100 put. It gives you a few bucks of break even below that. Of course, we're willing to lose up to $300 because that's what we're trying to make. So that really puts us down to about, on today at least, down to 95.75. Of course, as time passes, that purple line is going to go up, which means that that level that we're willing to take a loss will go down closer to 75. If you take a look at, here's our reset parameters. Here we go. That right there, as we get to 95 area, 95.75, that will be below all of these lows, where we take that loss and move on to something else. Again, a loss similar to what you're trying to get here, but you can see where the gains are trying to get because of how high volatility is right now. It's not too often that we'll get, about a 30% return, or excuse me, a 15% return on a margin call, on margin put. It's not too bad, again, considering the volatility that we have for a stock like this. And again, taking advantage of a stock that's pulled back rather sharply, anticipating that long lower shadow to form in the market. You would expect it to form on a lot of its components as well, considering how high correlations are, and Disney being one of those stocks that itself is trading really close to very important support level. All right, that wraps us up for today. As always, thank you very much for watching. Have a very Merry Christmas tomorrow, everybody. Again, we could have some fireworks the rest of this week, so stay tuned. I'll be trying to pop on and off here throughout the week as our classes. We don't have any classes scheduled for this week. It's a week that Brandon and I take off here to spend with family. But considering what's going on right now, we might pop on a day or two this week and do a market outlook to see what's happening in the markets and what it means and what we can expect to happen going forward. So again, have a great holiday with your families, friends, loved ones here tomorrow, and we'll see you all next time.